Why bank stocks could be the sleeper winners of 2025. Picture this, it's the start of 2025, and every news headline in the United States is obsessed with artificial intelligence companies, the next electric vehicle boom, or the hottest tech IPOs promising to change the world. That's where most American investors are chasing hype, throwing money at stocks that look exciting but are already overvalued. Meanwhile, in the background, something far more powerful is happening, and almost nobody is paying attention. Bank stocks, the so-called boring corner of Wall Street, are quietly setting up for one of the biggest rallies of the decade. If you think banks are just safe, slow-moving dividend plays, you're about to be shocked, because in 2025 US, banks aren't just stabilizing after a tough economic cycle. They're positioned to dominate. And for American investors who recognize this early, the payoff could be massive. Now let's break it down step by step. Over the last 3 years, banks have been through the fire. Inflation hit multi-decade highs. The Federal Reserve jacked up interest rates at the fastest pace since the 1980s, and consumers were forced to tighten their belts. On top of that, fears of recession led to a sell-off in financial stocks, driving valuations lower than they had been in years. To the average retail investor in the US, it might have looked like banks were finished. But here's the twist. Those exact challenges forced banks to get leaner, smarter, and more profitable. They cut unnecessary costs, improved efficiency, and fortified their balance sheets. Today, most major American banks are stronger than they were before the pandemic, and Wall Street hasn't priced that in yet. One of the biggest weapons banks carry into 2025 is the benefit of high interest rates. For you as a consumer, higher rates mean frustration, expensive mortgages, pricier credit card debt, and auto loans that feel out of reach. But for banks, those rates are gold. The higher the Fed keeps rates, the more profit banks make on their lending operations. This metric, known as the net interest margin, is exploding right now. Imagine JP Morgan Chase or Bank of America making billions more in revenue simply because they can charge more for loans while paying depositors less. That's exactly what's happening. And unlike speculative tech plays that burn cash chasing growth, banks are generating real profits in real time right here in the U.S. economy. But it doesn't stop there. U.S. banks are no longer just about lending. Over the last decade, they've diversified into wealth management, insurance, payment platforms, and fintech partnerships. That means they now have multiple streams of revenue. So even if loan demand slows, they still have other profit engines firing. Think about it. Americans are moving money into certificates of deposit, CDs, treasury investments, and digital financial products. And banks are right there monetizing every single shift in consumer behavior. So while the average investor is distracted by flashy AI names, banks are quietly taking a bigger slice of multiple financial markets. Here's why this matters to you as a U.S. investor. Bank stocks right now are trading at valuations that make no sense compared to their potential. Many are priced below their historical price to earnings averages because investors are still scared of recession risk. But history tells us something different. Every time banks get beaten down by fear, those who buy in at the bottom are rewarded with outsized gains when the recovery kicks in. That's where we are in 2025. The setup is almost too perfect. Strong balance sheets, expanding margins, multiple revenue streams, and cheap stock prices. The hook is simple. Don't let the noise of Wall Street's obsession with tech distract you from what could be the real sleeper win of 2025. Bank stocks aren't just safe havens anymore. They are ticking growth machines, and the smart money in America knows it. If you're watching this, you have the chance to see the opportunity before it splashed across the front page of Bloomberg and CNBC. The question is, will you act on it, or will you watch it pass by? Rising interest rates, turning pain into profit for banks, When most Americans hear the words rising interest rates, they immediately think of bad news. Higher mortgage rates put home ownership further out of reach. Auto loans make buying that dream truck or SUV more expensive, and credit card balances suddenly feel like quicksand, pulling you deeper into debt. It's no wonder so many U.S. households groan every time the Federal Reserve announces another rate hike. But here's the flip side of the story. While interest rates are painful for borrowers, they are a goldmine for banks, and by extension, for anyone holding bank stocks. What's a financial burden for everyday Americans often turns into a profit explosion for financial institutions. And if you're tuned in as an investor, that's an opportunity you don't want to ignore in 2025. Let's get into the mechanics. Banks make money through something called the net interest margin, NIM. That's simply the difference between what they earn from lending and what they pay out to depositors. For example, if a U.S. bank pays you 1% on your savings account, but charges another customer 7% on a mortgage, that 6% spread is pure profit for the bank. During periods of low interest rates, that margin gets squeezed. Banks don't earn much because they can't charge borrowers very high rates. But in a high rate environment like we're seeing today, the opposite happens. Margins expand, sometimes doubling or even tripling. That means banks are suddenly bringing in billions of extra dollars without adding risk or reinventing their business. Take JP Morgan Chase as a case study. In 2022, when rates were still rising, JP Morgan's net interest income, the revenue generated purely from lending, jumped by over 20 billion year over year. Fast forward to 2025, and with rates still elevated, many analysts project that these gains could continue or even accelerate. Multiply that across the entire U.S. banking system, from giants like Bank of America and Wells Fargo to regional players like PNC or Truist, and you're looking at a tidal wave of profitability that hasn't been fully recognized by Wall Street yet. The average American investor is still focused on the pain of higher borrowing costs, while savvy investors are eyeing the hidden reward. But here's where it gets even more interesting for U.S. investors. In 2025, higher rates don't just benefit traditional lending products. They also create demand for safe, income-generating financial tools like certificates of deposit, CDs, treasury bonds, and fixed income products. Guess who's in the perfect position to sell, manage, and profit from all of those? The banks. As Americans flock to these safer investments, banks are collecting fees, managing accounts, and earning spreads on every transaction. That's a secondary revenue stream that most retail investors don't even think about, but it significantly boosts overall bank earnings. Another overlooked angle is corporate banking. Large U.S. companies rely heavily on credit facilities, revolving loans, and treasury management services, all of which become more profitable for banks when rates are high. Think of it like this. Not only are banks making more money from the average American taking out a car loan, but they're also raking in higher margins from Fortune 500 companies managing billions in liquidity. That double benefit, retail plus corporate, is what makes the banking sector so uniquely positioned in today's economy. Now, let's zoom out. Why is this so important for you as an investor in the U.S.? Because Wall Street has a bad habit of overreacting in the short term and underestimating long-term trends. The stock market punished banks in 2023 and 2024, pricing in fears of loan defaults, consumer weakness, and a potential recession. But reality hasn't matched the fear. Loan defaults have stayed relatively stable, consumer spending hasn't collapsed, and banks have proven resilient. Meanwhile, their earnings potential has quietly soared thanks to these wider interest margins. That disconnect between perception and reality is where investors make their biggest gains. If the broader market wakes up to the true earnings power of banks in 2025, stock prices could climb fast. The bottom line is simple. In a high-rate environment, most Americans feel the squeeze, but banks cash in. And as an investor, you have a choice. You can be on the side that pays higher borrowing costs, or you can position yourself on the side that profits from them. In 2025, that means owning bank stocks before the rest of Wall Street catches on. Remember, markets reward those who anticipate the trend, not those who react to it after it makes headlines. If you're watching this right now, you're ahead of the curve, and that's where the real money gets made. When most people think about long-term growth in the U.S. stock market, their minds immediately jump to tech companies, biotech startups, or the next shiny innovation on Wall Street. But here's the reality that smart investors know. The financial sector is the backbone of the American economy. No industry can thrive, whether it's housing, tech, energy, or retail, without the flow of capital managed by banks. And in 2025, that backbone is stronger, more profitable, and more technologically advanced than ever before. While the media keeps distracting you with headlines about speculative sectors, banks are steadily positioning themselves as not just survivors, but outperformers. If you're serious about building wealth in the U.S., you cannot afford to ignore what's happening here. Let's talk about resilience. After the 2008 financial crisis, U.S. regulators forced banks to strengthen their balance sheets, maintain higher capital reserves, and undergo annual stress tests. At the time, these measures looked like a burden. Today, they're a massive advantage. American banks are better capitalized now than at any point in modern history. That means they're not just ready to handle shocks. They're built to thrive through them. Whether it's geopolitical tensions, inflationary waves, or short-term recessions, U.S. banks have fortress balance sheets that keep them stable while other sectors crumble. For an investor, that stability is priceless because it reduces the risk of catastrophic losses while still offering upside potential. Now add technology into the equation. Many Americans don't realize how aggressively banks have been investing in AI, automation, and digital platforms. From mobile apps that rival fintech startups to AI-driven risk management systems that cut costs and boost efficiency, banks are no longer old-fashioned brick-and-mortar institutions. They're transforming into tech-enabled financial giants. In fact, some of the biggest banks in the U.S. are now spending more on technology than many Silicon Valley firms. That means banks aren't just competing with fintech, they're absorbing its best ideas and scaling them faster. For long-term U.S. investors, this trend signals growth, innovation, and cost savings that directly translate into stronger earnings and higher stock prices. But here's the part that most investors overlook: global demand. The U.S. financial system is still the most trusted in the world. International corporations, governments, and high net worth individuals continue to rely on American banks for security, access to capital, and global transactions. That global trust creates a steady stream of revenue that doesn't depend solely on U.S. consumer behavior. So when you buy a bank stock, you're not just betting on American households taking out mortgages or credit cards. You're also gaining exposure to trillions in global financial flows. In 2025, with economic uncertainty high, that global trust in U.S. banks gives them an edge over every other sector. Now, let's tie it all together. We have banks with fortress balance sheets, exploding interest margins, diversified revenue streams, strong dividends, aggressive buybacks, heavy investment in technology, and global credibility. All of this is happening while their valuations remain historically cheap compared to overhyped sectors like tech. That's the setup professional investors dream about. The question is, will retail investors in the U.S. recognize it before Wall Street analysts upgrade their forecasts and prices surge? History shows that by the time the mainstream media finally catches on, the biggest gains are already gone. And that brings us to you. If you're watching this video, You're not just another investor scrolling through random stock tips. You're part of the small group that sees opportunities early. This is your wake-up call. Don't sit on the sidelines while banks quietly line up one of the strongest growth years in recent memory. If you want to stay ahead of the curve, here's what to do right now. Smash that like button so this message reaches more smart investors. Subscribe for weekly breakdowns of U.S. market opportunities, and drop a comment telling me which bank's stock you believe has the most upside in 2025. Because here's the hard truth. Wealth in America doesn't go to the people who wait for permission from CNBC. It goes to the people who act while others are distracted. This isn't just another investment story. It's a chance to get in early on what could be one of the most profitable, least hype plays of the year. And trust me, when those dividend checks hit your account and your portfolio climbs while others are chasing hype, you'll thank yourself for listening. So don't just watch history happen. Be part of it. The banks are ready. The opportunity is here. And the only question left is, are you going to take it, or are you going to watch someone else cash in? Dividends, buybacks, and shareholder power moves. When it comes to investing in the stock market, most Americans are chasing capital gains, buying a stock low, selling it high, and pocketing the difference. And while that strategy has its place, seasoned investors in the U.S. know that the real secret to long-term wealth is owning companies that pay you while you wait. That's exactly what makes bank stocks so compelling in 2025. Not only are they trading at attractive valuations with growth potential, but they also come with a powerful 1-2 punch, steady dividends and aggressive share buybacks. Together, these strategies create shareholder value in ways that tech stocks and speculative plays simply can't match. Let's break down why this matters for U.S. investors right now. First, dividends. For decades, American banks have been known as reliable dividend payers, returning a portion of their profits directly to shareholders each quarter. In today's uncertain environment, with inflation still eating into purchasing power and volatile headlines rocking the market every other week, those dividends act as a financial cushion. Think of it as cash flow insurance for your portfolio. Whether the market goes up or down, dividend checks keep coming in, giving you predictable income. For many Americans, especially retirees who depend on investments for living expenses, that stability is priceless. In fact, some of the largest banks in the U.S. are currently paying dividend yields in the 3% to 5% range, double or even triple what you get from the average S&P 500 company. Compare that to popular growth stocks that reinvest all their profits, or worse, have no profits at all. And it's easy to see why dividends make bank stocks especially attractive in 2025. But dividends are just the start. What really turbocharges shareholder returns is share buybacks. Here's how they work. When a bank uses its excess profits to buy back its own stock, the number of shares available in the market goes down. With fewer shares floating around, each one you hold instantly becomes more valuable because it represents a larger piece of the company. It's the corporate version of supply and demand, and it's incredibly powerful. For example, in 2023 and 2024, banks like J.P. Morgan and Goldman Sachs launched multi-billion-dollar buyback programs approved by regulators after stress tests. That trend hasn't slowed down in 2025. As banks continue to print record profits from higher interest margins, they're funneling more of that cash back into buybacks, directly enriching shareholders. For U.S. investors, this is like getting a bonus boost to your returns without lifting a finger. And here's where it gets even better. When you combine dividends with buybacks, you're looking at what's called total shareholder yield. This measure adds up all the ways a company returns value to shareholders. In some cases, U.S. banks are offering total shareholder yields north of 7% or even 8%. To put that in perspective, That's like having an investment that pays you nearly as much as a high-yield bond, but with the potential for stock price appreciation on top of it. In a market where tech stocks often swing 20% in a week with no income to cushion the blow, bank stocks look like a fortress of stability and profitability. Now, why does this matter specifically in 2025? Because the U.S. stock market is at a crossroads. Many popular growth sectors are overextended, with valuations that assume nothing will ever go wrong. But we know from history, whether it was the dot-com bubble in 2000 or the meme stock mania in 2021, hype-driven rallies don't last forever. Eventually, fundamentals take center stage. And when that shift happens, investors flock back to companies that are actually putting money in their pockets. Banks, with their strong dividends and buyback programs, are perfectly positioned to capture that flow of capital. It's not just about safety, it's about smart, consistent wealth building. For U.S. investors watching this, the takeaway is clear: bank stocks in 2025 are offering you more than just potential price appreciation. They're offering direct income and compounding value through dividends and buybacks. That's a rare combination in today's market. Imagine reinvesting your dividend checks into more shares, while at the same time the bank itself is reducing share supply with buybacks. Over time, your ownership stake grows larger and more profitable without you doing anything extra. That's how American investors quietly build fortunes, not by chasing hype, but by owning companies that consistently give back to their shareholders. So while the media keeps hyping up the next AI stock or crypto trend, remember, this boring doesn't mean bad. In fact, in investing, boring often means powerful. Bank stocks may not grab headlines, but they're writing dividend checks, shrinking share counts, and rewarding patient investors every single day. For those willing to look past the noise, 2025 could be the year where banks prove once again why they're the backbone of long-term wealth creation in America.